Hello investors and traders, today I'll speak about 3 dividend stocks for this year. So for most investors the new year brings with it a new opportunity. With all the 3 major US stocks indexes falling into a bear market last year, investors are hopeful that history will follow course once again and eventually send the border market higher. However, the 2022 bear market wasn't as painful for the Dow as the other major indexes. When it crossed the finish line, the Dow Jones ended 2022 lower but just 9%, which compares quite favorably to the 30 drop registered by Nasdaq. This outperformance is likely the result that this index is companies being predominantly profitable and time-tested. During periods of uncertainty, it can be smart move to all stakes in a boring business. So arguably the best thing about telecom stock is their predictable over-year success to the wireless service and smartphone have become basic necessities. Not even recessions or economic slowdowns have led to high retail churn rates. In other words, Verizon tend to generate predictable cash flow every year and Wall Street loves predictably. So let's have a look on the Verizon chart. We can see that now it's about 40 bucks. If we will check for the last 10 years, we can see here the range between 40 and 60 bucks. Now we are trading near the lower border of this range. Let's have a look on the fundamental parameters. We can see market cap about 174 billion. The dividend yield now very impressive, more than 6%, and the PE ratio only 9, so it's very low. Let's have a look on the projections. Yeah, it's a quite stable business in the future years. The EPS, earning per share, expected to be about 5 bucks per share. And the revenue, let's have a look on the revenue. Yeah, it's very stable and very predictable, business. And the dividend itself, yes, here we can see that last year's it's stable about 4, even sometimes higher than 4%. And also let's have a look on the marginality of this business. So we can see that for last 3 years it's quite stable. It was 12%, 14%, 16% for the 2021. So the marginal model and net income margin is quite stable. That's why I love this stock. By the way, the payout ratio here is only 55. It means that only half of its net income company pays as dividends. So I think it's a nice possibility even to increase it dividend payments. And let's have a look on the historical P ratio. Yeah, we can see that sometimes it was 16, 12. 11, but now it's only 9, so I think P9 it's quite nice P ratio. And by the way, let's have a look at the PS ratio, price per share. Yeah, sometimes it was about 2, so now it's very low, only 1.2, so it's not expensive stock, it's very cheap. And also the marginality and the stability of the business, it's does things that I like. And of course the dividend yield of 6%, I think it's very nice to your portfolio. The second stock for today, it's Intel. If there is a knock against Intel, it's that the semiconductor stock are cyclical and therefore prone to order or demand weakness when US and global economic growth falters. But between these concerns and the worries about AMD eating into Intel's center CPU market share, Intel's share price looks to be significantly de-risked. Let's have a look on the Intel chart. So look what we have here. In my mind, yeah, here it's impulse. So first wave, the second, the third, the fourth, and the fifth. The fourth wave, the correctional one, is here clean ABC move, ABC, and now most probably we are finishing this correctional wave C. And after this I'm expecting to see wave 5, and that wave usually is higher than 3, so there is a potential to show a growth higher than 70% in the future years. In this case, the potential is to grow is more than 100%. Let's by the way, now we can see that the Intel is very oversold. Oversold stock. Their side, the monthly basis is 35. Last time it was so low. It was on the dot-com crisis about 15 years ago. So I think it's very good time, at least considers buying the stock. The dividend yield is about 5%. Let's have a look on the fundamental parameters. We can see here the annual basis that the marginality is stable. It's quite decreasing, but net margin 25%, it's a lot. Market cap is more than 100 billion. It's a very big company. The payout ratio even lower than Verizon, about 45%. So also it's very good sign for the investors. Let's have a look on the projections. We can see that the projections failed from the last years, but for the future 3 years they are expecting EPS expected to show a slight growth, and but revenue, I think it will be very stable. Maybe it will be lower than the last 2 or 3 years, but anyway, all the future years, the company expected to earn about $60 billion. I think it's enough. It's enough for the safety of their dividends, and of course 5% dividend yield. I think it's very nice to receive such dividends, and also the valuation. I think for now, for Intel, it's very cheap and very low. Please, it's very important chart here. It's the main reason why Intel now is a good stock to buy. So here, look, PE for the last 6-7 years was usually about 20, about 15, about 60. Now it's low than 10. So you receive an IT company. The performance, by the way, from the beginning for the series is 10%. Anyway, you receive a dividend yield about 5%, P ratio very low, high marginality, quite stable business, and also Intel is now in the correction. It's always a very good time to buy interesting stocks in the corrections. And also the other side, the momentum indicator tells us that now maybe it can be very nice levels at least to consider this stock to buy. And the last stock for today, it's WBA. Like Intel, WBA is supporting its high yield is about 4 decades. Further, it's increased its base annual payout for the jaw-dropping 47 consecutive years. Suffice to say, this dividend is rock solid. So while it's not unusual for healthcare stocks to perform during periods of high volatility, WBA has been something of an exception of the rule, since a significant portion of its revenue is tied to its brick and mortar stores. WBA struggled mightily when lockdowns during the initial stages of the pandemic slowed its foot traffic to a roll. The good news is that the worst of the pandemic appears to be over, and WBA has been working on operating changes for years, deciding to make it more efficient and attractive to shoppers. So here, let's have a look on WBA chart. In my mind, here it's a range between 30 and 80 bucks, and it was the first wave, the second, the third, the fourth, and the fifth, and most probably here the fifth wave is finished. If we will go to the monthly time frame, so we can see that their size is only 42, so the stock now is oversold. So it can be a good time to consider this stock, the stock to buy. let's have a look on the marginality. The last year marginality is very low marginal business, about 2%, 3%. But anyway, the market cap is 30 billion, and interest and the dividend yield is now more than 1%. The projections for the EPS, earning per share, is stable, and the business also expected to be very stable in the future years. What else can I say? The PE, yeah, it's very cheap stock, because here look, the PS, price per share, is 24 cents. It means that for 24 cents you can buy $1 of this of revenue of these companies, So yeah, it's now the very comfortable valuation of this stock. We can have a nice dividend yield, higher than 5%, and also this stock seems to be in a correction. So it's better to buy the stock at about here in the lower level, about $30. It's much better than 50, 40 bucks. So WBA is the last stock for today. So I encourage you to subscribe to my channel, press the like button, and see you on the next time. Bye.